Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, October 7th, 2019. It's been, for the most part, a flat day, a little couple intraday back and forth rips and dips, but market's pretty much flat all day. So I wanted to get an update out before as we head into the final hour trading. It's 2:38 right now Eastern time, so I should get this video up to you guys a little after 3. What's happened so far today is QQQ did go on and inched above. There wasn't much of a reaction. There was a reaction on that trend line right there. You can see the validated, meaning a pullback there. So here's what I'm noticing now. So we pulled back, and as mentioned before, we have the big 189.40 level, and that is the top of the August trading range there. So we took out the trend line, not impulsively at all, went up, and 189.40 has been a brick wall today. These are 60-minute candles. You can see the top of all of these candles there. Closed a little bit above it there, but really not by much, not enough to call that a breakout. And so far a rejection, and pretty impulsive. This right now we're working on a bearish engulfing 60-minute candle. So you have a trend here. Look for these on the daily charts. Potential reversal sticks, and they work well on a 60-minute chart as well. Here's a bearish reversal right there. Bearish engulfing, I'm sorry, means the red candle, the body of that candle needs to engulf at least the previous candle, and the more the better. So you can see right there. And again, I have to caution, this candle is not finalized yet. We have another 21 minutes to go in this on this hourly stick. But so far, it will have, if it closes at or below this one here, it's going to engulf the previous 3 candles. And one trading strategy when you see those, whether it's a daily or a 60-minute time frame, obviously we're right now on a 60-minute chart. It'd be a shorter term trading time frame. So when you see that candle about to be finalized, or after it's finalized, meaning that the next candle starts, then you can one of 2 ways. You can take a short there with a stop just above the high, because remember, this again is a reversal stick. I'll go over this in a second, glass half full, glass empty stuff. I don't want to get off on a tangent, but we did take out that trend line, and currently it's a back test. So glass half full sees the market doing this. Glass half empty says failed break of that trend line, rejection at 189.40. Finalize this bearish engulfing, then we're going to go lower. We're going to drop back below the trend line, which would be a check mark too for a short trade. So I'm still favoring that scenario, but we'll see what happens here. Again, that's why I want to get this video out to you guys so you can watch this. All right, so the strategy, back to what I was saying, there is a couple. You can take a short when you get a bearish engulfing and set a stop. Ideally just above the top of the candle there, and what you can do sometimes, you want to keep an even tighter stop. I go a little bit above the midpoint sometimes, because sometimes they'll kick it back to just at or around or just slightly above the midpoint of the candle before going down. And ideally, when you get a bearish engulfing, you want a follow-through candle, or at least I like to see a follow-through candle, meaning another red candle afterwards, and second one would be even better. And then, as I often say too, if we do get a red candle, to me the redder the better, meaning the bigger the red candle, the better the sell signal. It'd be much better than a small little red candle like this, a big one like that. So we'll watch. Anything can happen. This thing can go the other way. You have to give it to the bulls. If I want to talk about the bullish scenario, we say that we've had a 4% run, now over 4% over the last 2.5 or almost 3 trading sessions, and this is just healthy and normal consolidation. You get very overbought in the near term, and you can say that it's bullish because the sellers aren't taken it down. They haven't taken back control. They haven't produced an impulsive rejection here. So again, the glass half full, or the bullish scenario, says this is just the market taking a consolidation day to digest the recent gains and work off the near-term overbought conditions. We'll see what happens. I already gave you where I think we go. At least come back here at about that 187 level. That line should be a little bit lower right there to get the bottom of the gap. So I said it this morning is 187, and then you have the bottom of the gap down here. I had that line there for a while at 185.90. That's about that midpoint gap city in the trading range. So we'll just leave that line there, even though the top of the gap is just a little bit above it, about 186. So those are levels to watch if you're, just looking for a near-term pullback short trade. That would be the most objective first target, the highest probability target, I should say. But based on where we're at in my overall analysis, including what's going on in the daily and the weekly charts, I'm more prone. I'm still sitting tight with swing short positions from way back here, scaled into in the August trading range in my longer term accounts. And I've for this point in time, I have my fill in shorts, or at least as much as I want to have. We still need to see those 200-day and 40-week moving averages get taken out on a weekly basis. There's some work to be done to open the door to a deeper sell-off. Therefore, I'm reserving some dry powder for that if and when that happens. But what I was going to say, if I were to just come into the day flat with all my positions and had nothing but cash and I wanted to short here, I would go ahead and short. It's objective, stop not too far above the recent highs, maybe above this 190.50 level. Again, it all depends on an entry, your entry and where you're targeting. And then if it starts to play out, just gradually trail down stops, periodically trail them. You get down to, let's say, this first or second target, move stops down to entry, etc. And if you're bullish, likewise, you can go long in this back test here, or if we do get that pullback, maybe it's all we get. Maybe it's the market's got a little ahead of themselves and they want to come in and back test the top of that gap, or maybe even backfill it. So if you are expecting the market to go to new highs, which it certainly could do, market's going to do whatever it wants, these would be your two objective buy points right here, the top and or the bottom of the gap. And going long on a pullback to support, I like to step in a little shy of the actual support level in case the buyers step in early. And so that would be just above 186, right around 186, a little above, or above the 187 level. So pretty much round numbers, 187, 186. Let's leave it at that. Anything much more than that, and like I said, this is, I'm still of the mindset, because nothing has changed technically. We had, as I told you, this 4% rally is run-of-the-mill stuff for a market with expanded volatility, with the VIX elevated right now. And so, you can say what you want on where you think the market's going. Bull's right, bear's right, but I can tell you right now, nobody can argue the trend since this point right here is still bearish. The market has made a series, has been making a series of lower highs so far and lower lows, which is the definition of a downtrend. Now, again, we take out that 190.53 level. We're going to take out these two previous reaction highs, which is also resistance level, and then that starts to call that near-term downtrend into question. It's no longer a series of lower highs there, and then you go and take out that next high, and especially this one, and you can pretty much say at that point right there the downtrend is over. And here's SPY 60-minute chart. You got to give them credit. I tell you, the bulls have just tried, very put a lot of effort into taking out 294, let's just say. And so far, a couple pops above it. One there failed. It ran up again at 294. Finally got above it, but not very impulsively. Kept above it on 3 consecutive 60-minute candles. But look, right back down. So this is the battleground. And again, these are ranges. It's not hard numbers. Somebody asked me today, or asked in the trading room, about which trend lines are on which are most important, which of these resistance levels. As you guys know, I like to cover, for the general stock market, I just focus NQ and SPY. Small caps is a completely different sector, an index, I should say, and they don't determine where the stock market goes. This is the stock market. The majority of the market cap is in the S&P 500 and Nasdaq 100. So they're gonna lead the way. And again, that's what I've been watching here. That 294, talking about it for months now. That was the cap, the upside limit back in August through early September, until we broke out here, and back tested several times, fell below it, rallied back up it, overshot it on that momentum fueled overshoot there. So far stalling out there. So you can't say the bears have won. You certainly can't say that right now, and I'm talking near term battle stuff, not long term. because they need to take it back down well below there. If they do, targets, if you're looking for likely pullback targets, well, there's the same one. There's a gap right here. There's the top of the gap and the bottom of the gap on SPY. You can replicate those lines right there. And that's the gap from last Wednesday, was it? Yes, Wednesday's gap down. Other things to note here before we get off these 60-minute charts. The PPO is starting to turn down. It hasn't made a bearish crossover, but the momentum is waning. You can see it kind of rolling over here, and you have that PPO signal line right at, I mean, a hair above, but for all intents and purposes, it's still back testing the zero line from above, and as it did right here. That's a trend indicator. It went bearish when the dotted white line crossed down below. Again, that's the 9 EMA or signal line. Bullish right here, so it was bullish from there to about there, and it has been bearish since that point in this downtrend. And if we are rejected here, it's going to come down and keep that going. Otherwise, if we go on to break out above the uptrend or downtrend line there and that 296 level, we'll probably have a clean definitive cross back above there. So that's SPY, and on QQQ, same story. Somebody had asked about those two. It's a little bit above. They asked me to update that, and how it hasn't crossed down yet. But you don't even have to look at this chart. I can tell you this right now. If you turned off the PPO indicator, took it off your chart, if you see QQQ break down and come in and hit especially this target here, that's going to bring that PPO back down and put it back below there. And that means that we'll have a whipsaw signal. False buy signal, if you will. Again, it's a trend indicator, and most importantly, I do not use that as a standalone buy and sell indicator. Too many whipsaw signals. Use it in conjunction with other technicals such as trend lines, horizontal price support, chart patterns, other things like that, to kind of get a kind of bigger picture. And of course, this tells us too what the trend is, as I just showed you, this series of lower highs. That's probably a more important, a very simple, and the pure definition of a trend. Again, the security making a series of lower highs and lower lows, more so than what this is telling you. Okay, and this is ES, S&P 500 futures. And so now we have what I like to call confirmed. We went from potential to confirmed negative divergence on the 60-minute chart, because if you look closely, you can see the PPO has crossed over. You can see it in the histogram here if you look really close, or the lines, that white line has now crossed down below. The white line here is a signal line. The orange line is your PPO line. So that effectively gave us a lower high right there. And that is the definition of negative divergence. Prices on the security making higher highs, and the indicators such as RSI and PPO down here making a lower high. And there's your trend line. We've had a couple 60-minute whips below, but as I said earlier today, we need to see 29.35 go, as well as this trend line. And it's a 60-minute chart, so this candle needs to, as I'm doing the video 9 minutes ago, if we go any lower or even stay here, we'll have a breakdown. There's a big, nice red candle through there. So if the ES can close, well below that, let's say below that 29.45 level, that should keep us below this uptrend line right here. And then your next sell signal comes on a break below 29.35, and that should open the door to I think a move all the way back down to this area here, and possibly quite more if this is just the end of a run of a counter trend bounce within a larger downtrend. That's yet to be seen, but here's your downtrend. Pretty big wave down, pretty big wave up, but still a downtrend, so we could most certainly continue down through there. And remember, we were stick saved. We came very close to the bottom of the August trading ranges on this drop on Thursday. And we get back down there again, and I would put extremely high odds that we will then go on down and break through the bottom of the ranges. This was, this charged up a lot of bulls and a lot of longs, no doubt. It certainly, hurt me being short and others that were short. Near term, again, it depends how position. If you're swing trading, it means nothing. The market is still below where, the last official short trade on QQQ, we added all the way back here. Right here at this point, right about, let me draw it here, and you can see as of today we're right back to where we started. So that, of those that gave it a little more room, like I said I would up here when we were up here on my stops, you went profitable on the trade, and then you went underwater by about or a little less than the same amount that, twice that you were profitable on, actually 3 times now, and we're right back to where it was. So that's my point, is the market's gone nowhere in in a couple months since we added that last official short trade. So I'm holding out to add it back again, new trade on QQQ, waiting to see a little more evidence. Let's see how this week shapes up. All right, what else did I want to show you? Okay, I think we were just looking at that. Yeah, we were the ES 60-minute chart. So here's NQ. Let's zoom in and tight. Let's recap for anybody new to the site. We had this 60-minute uptrend line here, bearish rising wedge pattern right there. That was the highs, actually. That line, forget about this one. That would have been had we pushed up and made a slightly marginal new high, and it wouldn't have changed anything in the technicals, which would have just extended the divergence. But so far, that was a high. This is our downtrend. We've been working our way down, and this is what I'm focused on right now. That's what happened. We have, again, on just like ES, we have confirmed negative divergence now. We have a breakdown of that trend line I posted in pre-market this morning. There's the uptrend line right there. Move down through it. But to really seal the deal, you need to take out that 77.22 level, as well as that comparable horizontal support on ES that I just showed you. So these are the levels I'll be watching. This candle should be finalized soon. We've got about 6 minutes for them to try to stick save it, meaning run it back up on or above this trend line. But it looks pretty good right now. I see a nice clean bearish rising wedge pattern confirmed with negative divergence, and that should mark the end of this counter trend rally and open the door for the next leg down. We'll see. Of course, I do have to caution. We're in within spitting distance of taking out the top of the trading range. That's what we tested today across the board. I'm going to zoom back out here. SPY, QQQ, NQ, which we're looking at here. That's what these blue lines on this chart are the salient levels here. You have the top of the August trading range, breakout, backtest, backtest, backtest. A little whippiness through there, but again, we're at that. And again, that's everything I covered today. So wouldn't take much to push this market up and put all that back behind us. And then that would quite likely open the door up for that move for a marginal new high. It's not going to change the longer term technicals, or the intermediate, I should say. Intermediate talking weeks to months, but it would change the near term technicals, which is really just days to maybe a few weeks. Skew that towards more bullish the higher we go. It's again not a single line or a single level that flips a switch from bearish to bullish. This is just, again, my read on the chart, but it certainly becomes harder to make a bearish case if we continue much up through where we're at right now. This is where we should reverse, ideally, to keep this near-term downtrend intact. That's just the easiest way to say it. And although I said we're not going to pay much attention to the weekly charts until we start to get into the week and see, or we see a huge, something crazy happen. I don't foresee it. I don't see anything huge on the economic calendar in the next few days. But of course, you could have a headline that comes out of, something on maybe on the trade wars or something else. And if that happens, then I'll update the weeklies. I just want to talk on the Wilshire. I'm very often, most often, looking at the S&P 500, the NASDAQ 100, and occasionally I'll look at the small caps or mid caps. The Wilshire 5000 is even more representative of the U.S. stock market than the S&P 500. It originally started, you could read all about it, just do a Google search and you go to Wilshire's site or Investopedia, they'll give you a description, but it started with 5,000 stocks way back when, and it's a little below that now. Think of it like the S&P 500, except instead of only large caps, you have all different small, mid caps. And so their claim, of course, the company's claim is that it is the most representative index of the stock market, and it's hard to argue with that claim, really. I'll tell you, it's very similar in weightings too. What I like about it is, like the S&P 500, it's much more diversified among its sectors than the tech-heavy NASDAQ 100. But like everything else, because it's this world we live in today, that the tech companies are the biggest companies in the world. They're lean, meaning very little debt, very cash, if any, very cash rich, high growth rates. And so it does make up about 21%, the lion's share, or at least the biggest weighting here of the Wilshire. And then you can see the rest: healthcare, financials. Like similar breakdown in weightings as to the S&P 500. So I want to just take a look at the chart here for you. All right, I need to center this, don't I? Yes, I do. All right, let's center that chart. Drag this screen down a little longer here. And this goes back 20 plus years here, and you can see just at a quick visual. I mean, again, you take a step back and you look at the bull and bear markets over the past couple decades. You know, here's your dot-com bubble on the top, vicious bear market that followed. Might not look like much because, again, when you're looking at 20-something years here, there's your bull market from 2002 to the 2007 highs, followed by the Great Recession, the 55% drop that we had there, about on par with that bear market, the previous one. And then we had this run up into the 2015 highs. Many indexes and sectors dropped more than 20%, so met that technical definition of a bear market, whereas the S&P 500 and I believe the Wilshire fell just a little shy. So some consider that a bear market and this a new bull, but really technically speaking, most accounts, this is all part of the same bull market. That was just a big correction, actually just like this one we had last quarter. And what I wanted to point out, and you can see it here, there's not a lot of lines, not a lot of annotations on this chart. We had the similarities. As you can see on this chart, I have the RSI up top and the PPO down below, guys. That's it. The similarities are divergent high, divergent top right there. I should have boxed that in like that. Divergent top, divergent top, divergent top. That's it. And this one, we had these pretty clean uptrend lines. This one you had, again, this I think. Well, whatever. I don't want to speak too much on fundamentals and what I think's going on. I know things got a little wonky when Trump was elected. The markets definitely didn't see that coming, and then you had a president that pushed through a tax cut, and which is something historically is done when the economy is slowing or in a recession already to spur economic growth. So, an analogy I use is, if you're race car driver and you're winning the race, you're way out front, you're almost to the finish line, and then you hit the nitrous oxide, which is going to blow your engine. It's going to give you a lot of speed, but if you run it too long, the engine will blow. I think that's what happened with the stock market. So this is where a correction, bear market probably should have come, and due to the all the fiscal stimulus from the Trump administration, the tax cuts, everything else, it gave a stay of execution to the bull market, and it kind of that you can see here too. Look at these horizontal lines. It's equally spaced, these last few bear markets, and so this one I think was I'll call it Ursa interruptus, which would be an interrupted bear market. And so far this is where we're at, but I guess where I'm going with this is you can see we had a divergent high, we had one there, we had a comparable correction, and we've pushed up now to extend the divergences that were already in place. So it's and you can see how overbought we were at that point in time. So that's bigger picture stuff. But again, right now, unlike there, we had a breakdown here. We broke down, and this is a kickback rally is what it appears to be. And do we get the next leg down? We don't have a clear uptrend line anymore. So this was the uptrend line I was going off of. But I can't really, I could try to draw one here, but I'd be forcing it. There's not a clean fit. So we just have to kind of watch price action and see where do we go from here. Does the market punch on and make a marginal new high? It's certainly possible. Come on, continue up. These divergences could extend, or maybe that's it. We'll see. Only time will tell. But that's where we go back to the daily and weekly charts. and try to get a better clue. And I've given you week trend lines on the S&P 500 and NASDAQ 100 weekly as well. I just don't have a trend line draw on here. Okay, finally, to wrap this up, I just want to show you. I had a member inquire today. Said, Randy, why don't you, you haven't really mentioned the financials much lately, and they're a big part of the market. They are. They are the third largest, almost very close to the second. Healthcare is, tech's the largest sector in the S&P 500 by far. In a distant second, you have healthcare at about 13%, and then financials right under 12 point something. Tech is about 22, over 22%. And so I did update this recently. It was in a comment. This is a comment. I just used the search function in the trading room to find it. You can also, if you're a silver member, you can use the search function right here. Type in a symbol and you should see it like I just did. So what I said back then, that was last Tuesday, said somebody brought it up and I said, well, here it is. It's pretty simple. XLF had come back to test this downtrend line right here. This was on, again, Tuesday of last week, down hard. And that was it. I said it's pretty simple stuff. Yeah, I'm sorry, I shouldn't say simple stuff, but my take on it was it would be bullish if XLF would, have a successful backtest and rally from there, or bearish if it moves impulsively back down below that trend line soon. So that was Tuesday of last week, and that was right here. We were on it, and what did we do? Well, we didn't just move below it, we moved impulsively below it. So that is that is bearish. That's a breakdown below that trend line. And since then, we had that turnaround on Thursday. We've rallied, but as of today, even Friday's close, and today we've come right back. You can see this is the updated chart. Look at where we're at. I have not modified that trend line or moved it. We are right there. This was, what I call a momentum-fueled overshoot. We had a trend day, a lot of buying into the close, so it's perfectly normal to overshoot a resistance level a little bit, especially if you come back down afterwards, and that's what we did. And you can see there was price resistance just over that, about 27.50. That it checked today, and or got checked on, and then fell back, and that's where we're at. It can still go either way. Look, here's the thing about a trend line. I always say this. It was a very clean trend line before. I'm going to zoom back out, and then I promise we'll wrap this video up. Here's how I view trend lines. So we had one where I start here, 2, 3, well, multiple reactions, but a cluster reactions. I like distinct reactions. So there's 3 distinct reactions right there, and then 4. When we gapped above it, that's another reaction. We gapped above it. That helps to validate it, and then that was a breakout, right? But it proved to be, just like the S&P 500, the market itself, a false breakout. Failed. Came back down impulsively down through it. But then we went back above it again, and then back below it again. So what's happened now is it was very valid up to this point. Failed there, a little less valid. You can say failed breakout, but then we went above it, now back below it. So what that does, and I'm not trying to be wishy-washy here, just it reduces the validity. I still think it's a valid trend line, just a little less valid than it was before. So just something to watch. If we do reverse here, then what it is, it's another reaction off that trend line. If we reverse, and it shows it that, look, there's still some validity, still traders watching that trend line, or whatever forces are causing XLF, the financials, to go up and down off it. However, if we come on right through it at that point, I'll probably remove that trend line, because we'll have another cross down below and through like it wasn't even there. Well, I shouldn't say wasn't even there. We stopped on it the other day on that Tuesday. So that is a reaction. I define a reaction as a pause and or any type of reaction, a pause, a bounce, a reversal, or in this case what we had on Wednesday, also a gap down below it, just like we gapped up on it right there when we broke out. So there's something to watch as well. And again, if financials being the second largest or third largest, and then XLV, like I just said, healthcare is the second largest, and kind of a messy chart, and that's why I haven't covered this a lot lately. You had this uptrend line here. We broke it and we're below it, but there's a mixed bag of technicals. I have bullish divergence right here on the daily time frame here with the indicators, and we had a downtrend line there, broke out, looked like it was good, came back in. So it's just this is just sloppy. So we'll just watch this one. for now. So you have conflicting technicals, if you will. You have the divergent low, which is bullish, and especially on the daily time frame, should lead to a rally, the next rally that should last months or more. When I see positive divergence on the daily, that's usually the catalyst for a multi-month rally, and in the bull market, usually a leg to new highs, or at least a major rally. But on the flip side, you have the breakdown of this trend line right here recently, and we're coming up. Any more upside, we're going to back test it, and it's a little bit of a sloppy trend line. You can, by sloppy I mean it's been sliced through quite a bit recently, but worth noting because that's the trend line off the lows on December 24th. Okay, so let me wrap it up here, and let's see how the day ends. We might not have any definitive clues if we park it here again, just like we did at Friday, right around give or take 294. Within a percent or so above it or below it. It's not going to tell us a whole lot. But if we start to see that impulsive selling, we get those confirmed 60-minute candles. The bearish candles I talked about in the futures, things like that, then that's a start. And here it is. So I just jumped over to that. I wanted to, since I told you those would be finalized before I was done with the video. They were, and you see what happens. Here's that NQ. We closed right on it. That's a stick save. Remember, we were down here below that trend line when I was doing the video earlier, and see they rallied it, park it right back on there. This stuff is not coincidence. This is how the technicals work. Right there, you cut it intra-period, closed right up on it. Right here, you cut it, broke it intra-period, but you closed well above it. Right here, you kissed it, reversed off it. Here, you broke it intra-period, closed right back on it. In this current 60-minute candle that'll take us into the close, we're trading a hair below it right now, but we have almost an hour to go, so we'll watch this. All right, I'm gonna wrap it up here, get this out to you, and told you if we do go down today and or tomorrow overnight, this is the next level. That'll be sell signal number 1, and this will be an additional sell signal that'll give us a greater chance that we're going considerably lower if we take out that 77.22. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.